Hello, everyone, and welcome to this episode of Junior Economic Club of Canada Interviews, or JEC for short. We are a federally registered nonprofit organization led by students committed to promoting learning and interest in the field of economics, business, and finance. Among our various initiatives and activities, we seek to have interviews with expert industry professionals who are so kind enough to share their invaluable knowledge and experiences to us youthful aspiring economists. My name is Andrew Wu, National Director of the Junior Economists, and I will be your host for today's episode. Today, I have the great honor and pleasure to be joined by Mr. Golombek, who is Managing Director of Tax and Real Estate Planning at CIBC Private Wealth. Mr. Golombek also frequently appears in the national media as an expert on taxation, and he has his own weekly column in the Financial Post and is a frequent guest on BNN Bloomberg. Mr. Golombek, thank you so much for being here. It's a privilege to have this opportunity to speak with you.
Yeah, looking forward to our chat. Thank you.
Thank you. Okay, so before just to begin, I'll just start off with a brief introduction question, just to help you get warmed up a little bit, and also just to help the audience and myself get to know you a little bit better. Does that
Sure.
sound good with you?
Yep, for sure.
Great, thank you. Okay, so as you know better than anyone, you've had an extensive career in finance and more specifically tax and estate planning. Could you share what initially inspired you to enter this field and the key steps that have led you to your current position?
Sure. So, I mean, it goes back to high school. Math was my strongest subject. I took all three maths in high school in Ontario. Did very well, got in the 90s in all the maths. And I didn't want to go into pure maths. My brother actually went into maths, became a math teacher, but I instead was interested in business and in making money. And so I pursued a commerce degree at McGill University in accounting and finance. I wanted to jump right into business. My dad suggested that instead, before I jump into business, get a professional designation. So he encouraged me to get at the time, chartered accountancy. Now it's the CPA, which allows me to apply my math and business to a profession that will always be in demand. So that's what I did. I studied accounting and finance, applied to the accounting firms, got my first job at an accounting firm, wrote the CPA exams, both in Canada and ultimately in the US. And initially, I started my career like most people do in the audit area, which I found quite boring. And I thought, well, I had a chance to try a few months as a rotation in the tax department. And I thought that, well, tax was exciting because it actually saved people money. And I thought, here's some huge value added. I mean, taxes for most Canadians are the number one expense. You'll probably spend more on taxes than you will on housing. Even if you buy a multi-million-dollar home, you'll probably pay more in taxes over your whole life than you will on your home. So taxes are number one, and the way to reduce taxes, legally reduce taxes, people appreciate it, and people also are willing to pay for it. And as long as you're providing value there. So that's kind of how I sort of transition into that area because I think it adds value. The system is complex. It's a bit of a game. It's a bit of a puzzle. And you always have to be on your toes because as we will talk about, the tax law changes daily with new cases coming out every day. And even recently this year in 2024, with the massive changes to the capital gains tax, first time in 20 years.
Of course, yeah. Thank you so much for sharing. I can see why taxes may be so interesting. It's, as you mentioned, almost like a puzzle, a sort of system you have to really navigate and figure out how you can get the best outcome for, I guess, those who you can really help. So I can definitely see the appeal in that. And so thank you for sharing. Okay, so I suppose we can dive into our main discussion now today. So just to begin off, can you explain, I know you mentioned this change in the capital gains tax, which is exactly what I'm going to get into now. Can you explain the somewhat recent changes to this new capital gains tax and why the government decided to implement them, and how effective you believe these changes are in achieving the government's objectives?
So look, I mean, capital gains happens when you sell an asset for a profit. So that could be a stock, that could be a bond, it could be a mutual fund, it could be a piece of investment real estate, pretty much anything you sell other than your principal residence. If you sell it for a gain, that's a capital gain. So in Canada, before 1972, we didn't actually tax capital gains at all because the theory was that you made money, you paid tax on that money, and you took your after-tax money and bought an asset. And if that asset went up in value, to tax that a second time would be, taxing the same amount of wealth twice. That was abandoned with the Carter Commission in the late 60s. There was a big study on tax reform, and ultimately they introduced a capital gains tax in 1972. And they basically said that only 50% of a gain will be taxable. And there's all kinds of reasons given as to why it should be 50% and not 100%. In fact, the original proposition, and there's a very famous saying, was that a buck is a buck is a buck. In other words, whether you earn $1 of employment income or business income or investment income or capital gains, it should all be taxed the same. But a lot of people said, well, look, not really. When it comes to capital gains, there's a few things going on. So number one, inflation. Like inflation is a big part of the price of assets and value. So if you're just taxing inflation, does that really make a lot of sense? If you have a gain that's purely the purchasing power of your asset is the same, but it's just gone up by 3% a year, let's say, for 10 years, you have a 30% gain. Does it make sense to tax that? So some people say, we'll give people a break. We'll only tax 50% of it. Other people have suggested that a break on capital gains tax is simply to encourage entrepreneurship, to encourage investment, to encourage risk taking. So that's certainly one argument. And a third argument would be, when you buy shares of a company and the company goes up in value, part of it is because it has earnings which have already been taxed. So to tax your investment in the shares, which is attributable to earnings that are retained in the company, is a form of double taxation. So all these benefits, all these reasons have lowered the capital gains rate. It's been as high as 75%, and it's been back down to 50%. So what happened this year, of course, on June 25th, is the government has has increased the capital gains inclusion rate from 50% to 2/3. So what they did is for any individuals who sell an asset on or after June 25th, the first $250,000 of gains each year will be taxable at the old rate, the 50% inclusion rate, but the new capital gains, anything above 250, the new rate is 2/3. So any gains each year that an individual has over 250,000 a year are now taxed at a 2/3 inclusion rate. And just to be clear, the tax that you pay is based on your own personal tax rate. We have a set of graduated progressive tax brackets. The higher you make, the more tax you pay on a progressive basis. And then you multiply your tax rate by your inclusion rate on your capital gain. So on the old view, it was 50%. Under the new rules, it's 2/3. So 2/3 of the gain over 250 is taxable. It's important to remember that for corporations and most trusts, they don't get the first $250,000 break, which means that all corporations who have a gain on or after June 25th, 2024 will now pay tax on 2/3 of that gain at their corporate tax rate for any dispositions on or after June 25th. They don't get the lower break on the first 250,000. So I think the reason the government's doing this is very clear, is they said that capital gains are earned mostly by the wealthy. They put some statistics out there, and they felt that the wealthy should pay a fair share or a fairer share of tax and should absorb more of the tax burden. And giving the average person $250,000 should be sufficient to cover off most people's capital gains. Of course, the main issues that we're seeing of this, of course, when you die, if you die, there's a disposition of all your property at fair market value. So it could very well be that in the year of death, your gains are over 250,000. So the effective tax rate is equivalent to about 9 percentage points more of tax. So if the top rate, for example, in Ontario was 26%, which is half the 53% normal rate for high income earners on the year of death, then potentially the rate is going up to 35%. So you are paying more tax on death. And the other issue is, again, on the sale of a family vacation property, it's been in the family for generations, and all of a sudden you die and you have a disposition, you're now going to tax a gain greater than 250. There certainly has been some opposition to it, but the government is counting on collecting $20 billion of revenue over 5 years as a result of this new tax measure. So we'll see what happens going forward, but that's kind of where we stand as of today, and today is October 2024.
Great. Thank you for walking us through that, how that entire process works, Mr. Golombek. So you've discussed a little bit that the main reason that the government imposed this higher capital gains tax is to raise tax revenue. And you mentioned $20 billion, which is quite a lot. However, as you also mentioned, there has been some pushback over this recent change in the tax. And so do you believe that there could have been any more effective solutions to raising tax revenue or cutting costs anywhere that could have
Well, I think
also.
that's, yeah, I mean, I think you nailed it right there with your second point. I think most people, at least that we speak to, is that the focus shouldn't be so much on raising taxes every year. They've already raised taxes significantly. You have marginal tax rates in almost every province in Canada, well over 50%, 53, 54%, Nova Scotia. I think it's 55%, one of the other eastern provinces like Newfoundland and Labrador. Once you give more than half your money away, it's kind of a psychological disincentive to work. I'm sure many of us have studied the Laffer curve. There's a point of maximum government revenue where if you start to achieve a tax rates of over 50%, the government actually loses money. So in my view, I don't think it's a tax issue. I think it's a spending issue, controlling budget, controlling spending, size of government, the normal stuff that you hear about. If they were to tinker with anything on the tax side, I think many economists would think that maybe tweaking the rate on the goods and services tax or the harmonized sales tax, which the government lowered a number of years ago, maybe bring that back up because that certainly taxes people's spending as opposed to people's income. So if you don't want to pay the tax, don't spend money, right? So there's different debates about that. The problem is that that tax is very visible. The income tax is hidden. You file your tax return, you don't know how the numbers get calculated. The average person doesn't understand the tax system, doesn't understand how they file their tax return. But HST, when I go to the store and I pay 13%, I see that 13%. And that's supposed to go back up to like 14 or 15%. I'm going to see that every time and be reminded of the government that did this to me. So it's not popular, but I think many economists would agree that we have the wrong tax mix. We're taxing income too much, and instead we should be taxing consumption, taxing spending. So that'll be an interesting thing, but so far this government has not taken that route. They've actually gone the opposite and lowered the federal GST.
Okay, that's an interesting insight then. I certainly wasn't, I guess, aware of the previous HST, I guess, being 15%. Okay, so thank you for sharing your thoughts on that then. So I guess moving on to our next point, which is how do you see recent tax policy shifts impacting long-term investment decisions, particularly in real estate and the capital markets? And what do you think a Canadian should be mindful of moving forward?
Look, it's a great question. This has actually been studied a lot in the whole area of behavioral finance, behavioral economics. And, there is something called the capital gains lock-in effect. It's been studied in the academic literature. You can Google it. People have written papers and dissertations on it. But I mean, the concept is very simple. If you have a big gain on your shares of Apple or NVIDIA, which at least at the time we're speaking has massive gains over the last little while, and here we are in October 2024, people are reluctant to sell because they have to pay the tax at the time they sell. And now that the tax rate has gone up, if your gains are over $250,000, which they could be in some cases, then people actually are reluctant to sell. And if people are reluctant to sell, you call this the capital gains lock-in effect. So we might argue from a economic perspective, from a prospective, what are the prospects of this company, making these kind of super returns over the next year or two? You might argue that this is the perfect time to take your profits to sell. But if I have to pay a 35% capital gains tax, I actually say, well, you know what, maybe I don't do it right now. I wait a little bit longer. And people keep waiting and waiting and they don't sell. And of course, sometimes the stock goes down, and we've seen that with other companies. We've seen that certainly with Nortel, and things like that. But you have to be cautious. And the concern is that a higher capital gains tax rate exacerbates this capital gains lock-in effect, which is very real. And again, it's a behavioral issue. It doesn't make rational sense. I mean, the theory is that when you sell a stock, you're going to replace it with a stock that will do better. But I guess most people believe that these stocks that have gone up will continue to go up forever, which is fine. But the bigger concern ultimately is the tax will be due, and some people would be better off. And one of the strategies we're actually recommending now is crystallizing at least $250,000 a year of capital gains in your portfolio, so that you pay tax at that lower inclusion rate rather than later on having to sell it or die and have the capital gains tax all at a 2/3 inclusion rate. So that's one proactive strategy that we've been suggesting, especially towards the end of each calendar year.
Well, that's a very interesting strategy then. So just definitely something I suppose our audience can perhaps keep in mind and then think about going forward. So sorry, just as a follow-up question to one of the points that you mentioned, this lock-in effect of how due to this uncertainty, a lot of people are choosing not to immediately sell their assets and thus triggering the capital gains tax. And so this just, I guess, brings up another question I had, which is that given the highly probable scenario of the Tories forming a government in 2025 and their uncertainty around certain tax policies, such as the capital gains tax, how do you believe that Canadian and foreign investors will or should adapt to this environment?
Yeah, so it's probably an issue, obviously, for Canadian investors because foreign investors could be in a totally different tax regime. And Canada doesn't tax capital gains, generally speaking, other than real estate for foreigners. But from a Canadian domestic perspective, that's a great question because a lot of people say, well, if Pierre and the Conservatives come in with a majority, surely they're going to cancel that. But I wouldn't be so sure. They certainly haven't said anything as of October the 1st, 2024, and they haven't promised to do that. And again, this is expensive, $20 billion, 5 years. How are they going to get that money back? And I think it might take some time if the Conservatives do come in 2025 with a majority, if not sooner. I think they'll look at the big picture, look at the spending, and maybe this is something they would do later on in their term, or maybe even on a second term. But it's expensive to do, right? Because now it's baked into the budget, and you've got to figure out a way to either cut spending, raise revenue somewhere else, or you're really going to be in a bigger problem. So yes, I do believe that ultimately the capital gains rate will come back down. It has gone up to 75%. It has come back down to 50. Now we're back at 2/3. So, it has happened before. Will it happen on day one if the Conservatives win? No, I don't think so. Anything possible. But certainly he's been pretty quiet about the capital gains issue. And he's also trying to support the common taxpayer. And $250,000 a year of gains is considered to be a lot. So maybe the average person isn't really affected.
Of course. Okay. Thank you for that. So I suppose just moving on, thank you so much for sharing your insight on the capital gains, explaining how it works, and your views on how Canadians should approach this going forward. I guess finally, our final point is just more of a general question, I suppose, which is we're asking, what's your takeaway on these changes in tax laws that you believe are important for the young adults of today's society to keep in mind going forward? So these are individuals who have recently stepped into or will soon be entering the workforce and begin earning an income, investing, and navigating the world of taxes and estate planning, which you are an expert in. And so we're just wondering, what advice or tips would you perhaps suggest to them, these young adults, and have them keep in mind going forward?
Sure. Well, I think like the good news is that there's so much you can do before even worrying about the capital gains tax, because certainly for someone young who's just entering the workforce, there is literally a plethora of tax-free accounts. So, for example, when you start working, if you can put some money away, first of all, start saving money. Like that's what I did. Like my first paycheck, I just put away 10%. There's a book out there. It's been written 30, 40 years ago called The Wealthy Barber. I encourage everyone to read it. It's old, but it makes sense. The theme of the book is save 10%. Like if you can afford to save 10% of your gross income, have it come right off your paycheck, you're going to be fine for the rest of your life. Most people can't afford to do that because they spend most of their money. So save 10%. The question then is how do we save it without tax? And there are so many options right now. We have the tax-free savings account, $7,000 per person after you reach the age of 18. Plus, you can go back if you're starting your first job at 22 or 23. You can go back 4 or 5 years and put in, the historical, either 6,500 or 7,000, depending on the year. So big opportunity there, right? Then we have the RSPs, right? You get a tax deduction for the amount you contribute to the RSP. For anyone who's young who doesn't own their home yet, don't forget the new first home savings accounts where you can put in $8,000 a year tax deductible into a first home savings account for up to 15 years, completely tax free, and then take it out tax free to buy your first home. When you start to have children, there's the registered education savings plan, the opportunity to save and get government grants. If someone in your family has a disability, there's a registered disability savings plan. Like there's literally so many different opportunities before the average young person will start paying tax on capital gains. So I think the key is work with a financial advisor. I would go to your either local bank or credit union or wherever you deal with, or even virtually. You could do a lot of this online. Meet with someone, have a discussion, and then look at your big picture and say, am I paying too much tax? And if so, what are the things I'm going to be proactive about to make sure, at least on investment income, most people, certainly in their 20s, if not 30s, shouldn't be paying a lot of tax on investment income because ultimately there's just so much opportunity now with all the registered plans that are available. So I think that's my best piece of advice. Stay on top of it, read the paper, read the Globe, read the Financial Post, gives you lots of great information in there. And just sort of stay on top and be proactive. Meet with a financial advisor if you're not comfortable. I have my own financial advisor. I don't pick my own stocks. My advisor chooses everything for me. I mean, I think do my own taxes, obviously, but when it comes to investing, if you don't feel comfortable doing it yourself, there's nothing to be ashamed of meeting with a financial advisor. So seek advice. A lot of great advisors out there, whether they're accountants, lawyers, or investment advisors, financial advisors. But I think that's really important. And again, the message that I would say up front is budgeting and saving. And again, save 10%. If you can afford from your very first paycheck to take 10% right off the top and save it without even seeing it, you won't spend it. And this will set you up for a lifetime of success in terms of long-term savings.
That's absolutely fantastic advice. Thank you so much for sharing that, Mr. Golombek. I'm sure our audience will definitely take that to mind, keep that in their but keep that in mind going forward when they're beginning to earn that income. Definitely, we advise people to save 10%. And as you've mentioned, if that sets them up for life, then that's fantastic. 10% hopefully is not too much, but I suppose this depends for everybody. But thank you so much for sharing all of that advice. That just about wraps up everything we wanted to ask. So thank you again for sharing everything and for taking this time today. We really appreciate you being with us and for providing us this opportunity. We're sure that the audience has learned a lot from your insights on the new capital gain, the changes in capital gains, as well as all the advice, the brilliant suggestions you've provided for how they should navigate taxes going forward and which accounts they should use to really help them legally save this money money in taxes. So thank you so much, Mr. Golombek. That is all for our discussion today. We wish you well in the future, and thank you. All the best.
Same to you. Thanks for having me.